Hey guys, what's up? I'm Erin and welcome back to the channel. Have you ever wondered where your money goes when you invest in the S&P 500? Well, you might be surprised to learn that a good chunk of your money is actually funneled into just a handful of companies. Let's first look at index funds, one of the most popular investing vehicles out there. And here's where it shows in terms of dollars invested. Roughly 43% of all new investing dollars go directly into index funds and ETFs, meaning that for every $100 from investors that gets put into the stock market, 43 of those dollars goes directly into index funds. Currently, index funds and ETFs make up about 50% of the investing market, but some analysts project that within the next decade, they could make up as much as 70% of investable assets. And index funds have a big lure. Investors are more and more drawn to passive investing styles driven by lower fees, simplicity, and just generally strong performance, especially when compared to actively managed funds or having to choose your own individual stocks. I too am a self-proclaimed indexer. I choose to predominantly invest in index funds after reading the Little Book of Common Sense Investing by the late, great Mr. Jack Bogle. The other big selling point that you often hear about when it comes to index funds is instant diversification. For instance, if you consider an index fund that tracks one of the most popular indices out there, say the S&P 500, if you direct your investing dollars there, you might automatically assume that your investing dollars are then spread out among, say, 500 companies or so, right? Well, they are, but maybe not exactly in the way you might think. The first thing to keep in mind is that the S&P 500 is a market capitalization weighted index, meaning that each of the companies on the index is weighted according to its size. So the larger companies make up a greater proportion of the index and thus attract more investing dollars. So it's not as though if you were to say invest $500, that $1 would go to each company. Instead, the largest companies capture a greater percentage of those investing dollars, and the percentage may surprise you. As of June 2024, the 10 largest companies on the S&P 500 made up 37% of the index, meaning that if you were to invest $100 into an S&P 500 tracking fund, $37 would go directly to the 10 largest companies, and the remaining $63 would go to the other 490 companies. And that may not be the great level of diversification that you're expecting. In fact, what have been dubbed the Magnificent Seven, Apple, Amazon, Alphabet, Meta, Microsoft, Nvidia, and Tesla make up 31% of the S&P 500 index. The big thing to keep in mind is that we as investors may be more concentrated than we realize when we invest in these indices. It's not inherently a good thing or a bad thing, just something to keep in mind. When it comes to having more of our investing dollars tied up in relatively few companies, this can bring with it a few risks. Increased volatility. With a higher concentration, the performance of an index becomes more dependent on the performance of a few large stocks. If these stocks perform poorly, they can affect the entire index. And sector risk should also be mentioned, as the Magnificent Seven are all within the tech sector. So investors who invest heavily within the S&P 500 are going to be heavily weighted towards tech, whether that's their intention or not. Systemic risk. Larger companies have a broader impact on the overall market, and bigger problems within these companies can cause a bigger influence on the market and individual portfolios. Consider the infamous example of Enron. Before it imploded, it was a large and prominent company on the S&P 500 index. It was considered a major player in the energy sector. It was in the top 20 based on market capitalization on the S&P 500. So certainly a key component of the index, and certainly a major player that impacted the index itself. That's why its downfall rippled through the entire investing community. When we give more of our dollars to just a few companies, we rest more of our financial fate in their hands. Which brings us to diversification risk. Higher concentration in just a few companies reduces the diversification benefits of investing in the index. Diversification typically helps to mitigate risk by having an investor spread their dollars over many companies in many industries. But by having these highly concentrated indices, it can expose investors to a higher risk than they thought they would otherwise be. We also run the risk of overvaluing popular stocks that can lead to bubbles, especially in today's social media-driven world. It can be incredibly easy for these popular companies to garner a great deal of hype and consequently attract additional investment because of this hype. On the subject of diversification, as some of these companies start to attract a lot of hype and make a lot of headlines, some investors start to invest in these individual stocks. But some of these investors who are already heavily invested in index funds may not be aware that they already have a sizable portion of their investments in these companies themselves, just through their index funds. We saw this in previous years with Apple and Tesla stock, and again this year with Nvidia. Some investors see these companies make headlines and think to themselves, I can't miss the opportunity to invest in these companies, but they may not realize that they're already holding an investment in these companies, and that's just through an ETF or through an index fund. There's nothing wrong with buying individual stocks, but it's just important to understand your entire portfolio before you're making investment decisions. And just because there are risks with greater concentration doesn't mean there aren't benefits as well, because there certainly can be. Concentrated indices tend to feature industry leaders and innovators who have a high growth potential, and if these companies continue to perform well, that can result in higher returns. Let's use the S&P 500 as an example again. The S&P performed quite well in 2023, achieving a total return of almost 27% when including dividends. However, if you were to exclude the Magnificent Seven, the index would have only risen 8%. This shows just how powerful of an impact these few companies had on the overall performance of the index itself. Now, if you had invested directly in these Magnificent Seven themselves, would your portfolio have performed better? Yes. For instance, if you had invested $10,000 equally across the Magnificent Seven at the start of 2023, by the end of 2023, it would have been worth almost $18,000. Compare that to a $10,000 investment in the S&P 500, which would have grown to be worth about $12,600. Or what if we took this example to the extreme? The best performing stock of the Magnificent Seven was Nvidia in 2023, with a 239% return. A $10,000 investment in Nvidia at the start of 2023 would have turned into roughly $34,000 by the end of 2023. But remember, it is incredibly hard to pick and choose the winners. Without the Magnificent Seven in the S&P 500, a $10,000 investment would have grown to just $10,800. Greater concentration can absolutely boost overall performance during the good times, but remember, it can certainly be a drag on performance during the bad times, so there still is a benefit to diversification. Larger companies can take advantage of economies of scale, leading to greater efficiencies than smaller companies. These companies have greater resources to invest in research and development and marketing and expansion. That gives them greater growth potential. Investors may perceive larger companies as more stable and resilient, particularly during economic downturns. Companies with stronger brand tend to attract more investment, and this can bring greater overall stability to an index. For instance, even in a market downturn, consumers will still likely want to buy Apple and Microsoft products. Even in a market downturn, they're still going to continue using Google and Facebook. I still think index investing is a phenomenal way to be investing. No matter what your style of investing, it's important to understand the portfolio you're building. So when you invest like this, it's important to understand you might not be as diversified as you might have otherwise thought. When you invest in 500 stocks, it's not as though you own these 500 stocks in equal measure. And honestly, how important diversification is to you really depends on you as an individual investor. If you're just getting started out in your career and you have several decades of runway ahead of you, you can withstand a lot of ups and downs in your investing time horizon. So at that point, maybe diversification isn't really a priority. However, if you are nearing retirement, having a portfolio that is so heavily concentrated into relatively few stocks may not be the best plan. This is where life cycle planning comes into play. You're likely going to want a very different portfolio at 20 than you want at, say, 40. And again, you're going to want a different portfolio when you, say, hit 60. So if you're 20 years old and have 100% of your investments sitting in an S&P tracking fund, that's a very different picture than someone who's, say, 60 and has 100% of their investments sitting in an S&P tracking fund. At the later stages of life, you probably want to add some more diversification to protect yourself and your portfolio. What are your thoughts on the concentration of these indices, like the S&P 500? Share them in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. Sitting in an S&P 500 stock, index cycle planning comes into play. This is, itchy nose. That's annoying. Come on, get on with it. Let's go.